I think there's a lot of slack and a lot of frothiness in the market, which will have to come out. And it's just classic J-curve dynamics. When you get sort of the hype cycle, you get too much supply of these companies. You get, everyone and their aunt putting .ai on their marketing deck.
Welcome to PitchBook Outlooks. In this series, we speak to our analysts to talk about current trends and future opportunities that are unfolding to give our investors the best chance that they have to beat the market. I'm Andrew Woodman, and today I am being joined here with Navina Rajan to talk about the EMEA private capital outlook for 2026. Navina, the outlook this year lands at a very interesting time. There's a lot of uncertainty in the market geopolitically. There are a lot of headwinds. We're seeing that PE deal flow is up. Fundraising continues to be difficult. On the VC side, it's not been the best year, but then also we're seeing a much more dominance from sectors like AI, of course, which is now accounting for a large share of the activity in the space. So just if you could just tell us, what are the main things that have jumped out at you when you've been compiling this outlook?
Yeah, I think there are several moving parts. When it comes to, obviously, VC and PE, very different dynamics. In VC, we think the IPO window in the AI market has really been the key shapers of activity in the ecosystem this year and will be pivotal going forward. And then within private equity, so PE-backed spaces, we think just the private equity inventory and the sort of the companies that are staying private for longer, and this public-to-private convergence is a very interesting thematic. As well as just the US participation within the private equity market.
So going to AI, AI investment is taking up a larger share of VC funding. There, understandably, is a lot of talk of a bubble and frothy valuations. From your perspective, what do you think of the risks are of a kind of a correction in the near term?
Yeah, I think AI has, understandably and undeniably been the flavor of 2025. It's been the biggest sector, been the biggest vertical, where we've seen the biggest deal investment. I think when you look at Europe and the penetration, around 38% of deal value within Europe, VC, has been from AI deals. That's still underpenetrated when it comes to the US. So in the US, nearly 2/3, around 63% of AI deal value has been generated. So I think there's still significant room and headroom for Europe to climb. And there's several structural features that support that. I think Europe's ecosystem is earlier on the development curve. It's more nascent, it's more underpenetrated. You obviously got a big valuation gap as well between Europe and the US, which always is the case, but I think with AI that's more pronounced. So there's definitely more runway and more sort of ecosystems which are yet to emerge. I think we're sort of maybe 5 years or so behind the US. So as that grows, what we're expecting is that 38% to reach around 50% of AI deal value by the end of 2026. So it'll be a significant portion of the VC-backed ecosystem in Europe. It's really the valuation point, which I think the bubble refers to, and we should look at it from a point of view of sort of penetration, but also in terms of the multiple that these companies are raising financing at versus what they're actually generating. I think there's a lot of slack and a lot of frothiness in the market, which will have to come out. And it's just classic J-curve dynamics. When you get sort of the hype cycle, you get too much supply of these companies. You get, everyone and their aunt putting .ai on their marketing deck. And then the actual fundamental business proposition might not be an AI-enabled company, or there might just be too much competition, which needs to come out the market. So that rationalization will need to happen, but I still think that it's not really imminent given the fact we're still underpenetrated compared to the US, and also these technologies are still quite nascent.
So looking at that lag of Europe behind the US, obviously you've already talked about kind of the market maturity, but are there also deeper structural issues that are kind of threatening to hamper development of AI in Europe and investment in Europe, things like regulation?
Yeah, I think there's generally a structural, take AI out of it, there's a structural difference between Europe and the US. We've always had lower valuations in Europe versus the US. So there is an element where you need to take the market out when you benchmark these things. We can't really, I don't think we will ever get to the value of the US. For instance, in the US, the top 10 AI deals amounted to around 110 billion euros. If you look at the top 10 AI deals in Europe, it's nearly 10 billion. So the discrepancy in check sizes, in capital pools available, in funding cycles, in just the level of share capital going into the market, and also the TAM and the addressable market is larger in the US. So there are these structural differences. Europe is definitely more fragmented, and so it's not an apples to apples comparison. But given that, I said Europe's 38% of deal value is AI. In the US, it's more than 2/3, around 68, 66% of deal value is in AI. So there is more room to grow. And then on top of that, you've got the regulatory backdrop. So you've got the AI Act, which Europe has definitely pioneered. And there is sort of a mixed bag in there. Generally, we're more conservative when it comes to regulation. In Europe, there's more bureaucracy, which can be viewed as a hindrance. But at the same time, I do think that regulation is critical when it comes to such a structural seismic shift in technologies, and something that will impact our safety, will impact copyrights, will impact intellectual property in such a massive way.
Going to the point actually of looking at this difference we have between Europe and the US, another area where the contrast is very pronounced is IPOs. Looking at the European IPO market, it's been tough for the past couple of years. We've arguably seen green shoots. The IPO value is up. Specifically, Klarna comes to mind, Swedish company, but did list in the US. So what is the outlook with regards to the European IPO market?
When we look at the data through 2025, valuations and volatility is how we define an IPO window. So both of those have to be favourable. And we've had favourable market conditions. If you look ex-Trump Liberation Day sort of mayhem, valuations recovered, volatility also subsided, and those dynamics have continued towards the end, the second half of 2025. In terms of IPO counts, however, last year, for instance, we had 181 IPOs in 2024 in Europe. This year, we've only had 115 despite favourable dynamics. So our view is that, ceteris paribus, all else equal, hopefully no more sort of geopolitical macro volatility, we expect the window to be open and we expect counts to continue to catch up. We do, however, think that from a value point of view, there will be sort of more of a concentrated recovery. So a fewer larger listings, such as your Klarnas. In the US, we've had a lot of AI listings. But in Europe, we have less of those larger scaled, new sort of nascent AI companies, like we've had the CoreWeaves and the likes in the US. So I think it's a different ecosystem. If you look at our VC Exit Predictor IPO pipeline, you can see the makeup of sectors is definitely diverse, definitely driven by fintech obviously being the more mature market here within Europe. But I think that volatility valuation piece should hopefully stay favourable. There's another question as well, as like the type of IPOs coming to market, the type of businesses, and also this private for longer thematic, which I think is also really pivotal for this discussion.
I'll come to that in a sec, actually. When you look at this pipeline, we do have sort of IPOs that are in the offing, sort of like Lovable. And are we going to continue to see those listed in the US?
If you're a mature venture growth company, and especially within AI, the valuation you can get within the US versus Europe is definitely higher. I would say, however, the nature of listings in Europe are more favoured towards profitable listings. So we track the percentage of profitable IPOs that list, and it's really nearly 90% last year that were profitable, positive EBITDA IPOs. In Europe, we're generally more conservative, less growth focused. We don't have the S&P 500. So I think investors in public listings, what the appetite for is really for profitable companies that are cash generating, especially like within VC and tech, where generally these VC-backed IPOs have been less profitable historically, and returns have not really matched those within the US and within other PE-backed IPOs, for instance.
Going back to the point about the PE-backed companies versus publicly listed companies, that ratio, we've seen a massive structural kind of change in this outlook that we've identified, which is the ratio has gone to 2.3 PE-backed companies to public market companies. So what is going on there? And is this something that we're going to see continue to ramp up in terms of that ratio growing?
Yeah, since 2014, we've actually seen private company inventories just for PE-backed firms nearly double to around 14,000 year to date cumulatively, whereas the number of publicly listed firms has oscillated from around 5,000 to 7,000 and has actually been trending downwards recently. So we've seen the amount of PE-backed companies overtake public companies nearly now 6-7 years ago. And I think that's going to continue. Private for longer, which I mentioned earlier, as more companies stay private because they can also maintain their higher valuation versus publicly listed companies. When we look at M&A buyout multiples versus index multiples, for instance. So the divergence is structural. PE has consistently delivered strong risk-adjusted returns as an asset class, drawing in not only institutional allocators historically, but now we think private wealth is a strong pillar for growth in private markets overall for the next mid to long term through semi-liquid fund structures and also evergreen funds, which we're seeing more and more being utilized within private markets. So I think, you've got two sort of things happening. You've got the dynamic of less private equity-backed companies listing, but then you've also got more take-privates happening. So we've seen take-private deal value have record years in the last year or two, and sort of that shrinkage of public markets happening versus the growth within private markets as well. So I'd say overall, when it comes to 2026, what we're expecting is that, and we're hoping that the European IPO window stays open when it comes to wider market metrics such as valuations and volatility. But most of the listings we're expecting should be profitable listings, those that are generating positive cash flows and therefore able to actually have enough investor appetite to list.
So in terms of where the investment is coming from, US participation in private equity deals in Europe is on the rise, and next year it's expected to take up to a quarter of transactions. So I suppose my question is, what is motivating US sponsors to increase their European exposure?
Yeah, so year to date, what we've seen is that 1 in 5 European PE transactions have had a US investor on them. And this is up from around 18% in 2024. And it's really in the sort of large cap mega deal space that US involvement is even more pronounced. So if you look at sort of the top 10 European deals, 7 of them in the second half of 2025 included a US investor. And several forces are driving this. So I think from a macro perspective, you've had more sort of monetary easing within Europe. Rates are now sort of half the level that they are within the US, if I'm being very sort of back of the envelope. So that rate differential combined with Europe's structural valuation discount and just a more fragmented M&A market, those bargain valuations has really created an attractive entry point for US investors and US buyers. So that's definitely what's happening. Now what we're seeing from a volume perspective, the amount of deal volume when it comes to M&A within Europe has actually surpassed North America, driven by sort of a rich pipeline of sort of mid-market opportunities. And there are even ecosystems where this is even higher. So if you look at the UK, for instance, the continent's largest PE market, US participation is even higher. 1 in every 3 deals has had a US participator. And then major sponsors such as KKR, Blackstone, CD&R have expanded their European commitments. So I think it's a very interesting time. I think especially when you sort of contrast PE versus VC, just the valuation differential, the more fragmentation that's happening. It's definitely more of a ripe, rich ecosystem for US participation, and we expect that to grow to around 25% by the end of 2026.
Well, there's a lot more interesting analysis to be found in the full outlook, and I encourage the viewers to download that and have a look and see what's coming up for 2026. Navina, thank you so much for your time and your insights, and I look forward to catching up with you next year as these trends unfold.